Welcome to Talk Tickers. Today we're diving straight into Ferrari's first quarter 2025 earnings call. They've put up some pretty impressive numbers. Let's unpack what's driving this performance and, what it might signal.
Indeed. It really looks like a business with significant momentum right now. We saw strong financials, but also some important strategic moves, particularly around their cars and electrification.
Okay, let's get right into those main figures then. Ferrari reported strong double-digit growth across all the key metrics. Revenues hit roughly 1.8 billion euros. But the really interesting part, only a slight increase in deliveries. What's that telling us?
Yeah, that's key. It strongly suggests they're focused on, let's say, revenue quality, not just quantity. Driving revenue up like that without huge volume increases really points to their brand strength, their pricing power.
Right.
And you see that in the profitability too. Adjusted EBITDA was close to 700 million euros. Pretty healthy.
Absolutely. And the cash generation, wow. Industrial free cash flow over 600 million euros for just the quarter. Beyond the pure numbers, the brand momentum seems really strong too. That order book now stretches into 2026. Apparently driven by the Roma Spider and the 296 GTS Spider. That's quite a runway.
It really is. That long order book gives them, well, a lot of visibility for future revenue. Shows the demand is there, the customers are sticky, and these new models are hitting the mark. Takes away some uncertainty,
Okay, let's dig a bit deeper then. Product performance. That new 296 Special Series, the Coupe and Spider, with the 880 horsepower hybrid, seems like a big hit. They mentioned significant client enthusiasm, design, performance, even things like the gear change feel.
Yeah, that enthusiasm is crucial. It validates their R&D spend, especially on hybrids. Good early feedback like that usually translates into strong orders, right?
Right.
And it supports that premium pricing. Shows they know what their clients want. Performance, yes, but also the whole driving experience.
And then there's the Ferrari Electric. They're doing this multi-stage reveal. Technology first in October 25, then interior design early 26, full car in spring 26, deliveries later that year. Why drag it out like that?
Well, it's probably a few things. It lets them control the story, build anticipation, keep the buzz going. Revealing the tech first lets them show off their engineering chops before you even see the car. Plus, it spreads out the marketing effort, keeps them in the headlines, suggests they're pretty confident in what they've got at each stage.
And we can't ignore motorsport. A 1-2-3 in Qatar in the World Endurance Championship and winning at Imola. First home win in, over 50 years? Formula One's maybe a bit more challenging early on, but they're still focused on progress there too. How much does the racing really matter?
Oh, it's huge for Ferrari. It's baked into their DNA, isn't it? Winning boosts prestige, excites fans, sure, but it's also a test bed. Tech developed there often finds its way into road cars eventually. That performance heritage is just core to the brand.
And they're pushing the lifestyle side too, right? New collectibles at Milan Design Week, trying to embed the brand even further.
Exactly. It broadens the appeal, creates more touch points with customers, even those who maybe don't own a car yet. And, well, it's another potential revenue stream separate from the car sales cycle.
Also worth a quick mention that LED Platinum certification for a rebuilt facility, ticking the sustainability box.
Yeah, and that's increasingly important, not just ethically, but for stakeholders, investors, maybe even efficiency gains down the line.
Okay, let's switch gears to the nitty-gritty financials. Shipments were up slightly, driven by models like the Roma Spider, 296 GTS, the SF90 XX cars, and the Purosangue still ramping up. Industry ramp-up continued, first Spiders delivered, but fewer 296 GTBs and Daytona SP3s as planned. SF90 Spider winding down. It all seems very managed.
Definitely. That careful product lifecycle management is pretty central to maintaining exclusivity and justifying those prices.
Yeah.
Rolling out new models, phasing out old ones. It's how they manage the revenue stream effectively.
Revenue growth was strong, 12.2% at constant currency, and driven by, as you said, a richer mix, both product and country mix. Plus, get this, personalization accounted for over 19% of car revenues. That's huge. They also got a boost from exchange rates and sponsorships, like that big HP deal with the F1 team, but that 19%.
It's really striking, isn't it? Shows how much customers are willing to pay for bespoke touches. That directly lifts the average price per car, reinforces that ultra-premium positioning. And yeah, sponsorship money is a nice bonus on top.
Adjusted EBIT was up too. Again, driven by that strong mix and price high-margin cars like the SF90 XX, Duisendry, the limited 499p Modificata, plus more personalization, good country mix in the Americas. Offsetting that were higher costs, racing, innovation, brand stuff. The lower depreciation helped a bit. It's a balancing act.
Absolutely. They're clearly investing for the long term in R&D and the brand, while still delivering strong profit now. That's the goal.
Yeah.
The lower depreciation is just a normal accounting thing as assets age, but yeah, it helps the bottom line.
Industrial free cash flow, as we said, very strong, helped by profits, but also working capital changes, including, interestingly, initial deposits for the upcoming electric car, the F8X. Net industrial debt was tiny, just 49 million euros end of March, even with share buybacks. And they flagged a dividend and a bond payment coming in Q2. Looks very healthy financially.
Yes, that strong cash flow gives them a lot of flexibility for investing, for returning cash to shareholders, keeping the balance sheet strong, and those early EV deposits, that's a good sign of market interest, even this far out.
They also confirmed their 2025 guidance. They did mention that risk from U.S. tariffs they'd flagged before, about 50 basis points on margins, but they say they've addressed that through commercial policy updates, still keeping an eye on the global economy, currencies, using hedging. And they expect a stronger first half than second half this year, mainly due to product mix and when expenses fall. Important for investors to note that timing.
Yeah, proactively managing things like tariffs shows they're on the ball. And understanding that first half, second half phasing helps set expectations correctly.
Okay, moving to some highlights from the Q&A session. It sounds like despite all the economic uncertainty out there, they haven't seen a big hit to the order book or more cancellations. Demand seems pretty consistent across different types of clients to new, existing top collectors. That's reassuring.
That resilience is pretty telling, isn't it? Speaks to the brand's desirability and perhaps the financial strength of their customer base. They seem somewhat insulated from the broader bumps.
They do expect Q2 deliveries to be a bit lighter than Q1, partly because the Daytona SP3 production is finishing up. And importantly, no big inventory buildup in the US before tariffs hit. And no wave of cancellations because of them either. Ferrari actually absorbed some of the tariff impact for clients.
That's a smart move, probably. Absorbing some of that cost, builds goodwill, strengthens relationships in a key market like the US. Long-term thinking.
Personalization demand, still very strong across all models, especially things like functional bits, special paints, lots of carbon fiber, and apparently demand for it is still growing.
That makes sense. It's a huge part of the appeal, that exclusivity. And it's very high margin for them. So growing demand there is great news for revenue quality.
The HP sponsorship deal is definitely positive financially, but hard to pin down an exact run rate yet. Comparisons are tricky. They delivered 77 Daytona SP3s in Q1. They are expecting EBITDA margins to be a bit lower for the rest of the year, though. Why? Less rich mix, basically fewer Daytonas, plus higher spending on SG&A and R&D, including racing. Investors should probably factor that in.
Right. Understanding those drivers for the margin outlook is key. It's planned, shifting mix, strategic investments, not necessarily a negative signal, just part of the plan.
Customer reaction to the Duisenderie sounds very positive everywhere, though taxes, like in China, can affect demand for certain models. Those initial deposits for the electric F8X, pretty significant in Q1, expecting a smaller positive impact in Q4 based on timing.
Yeah, the regional differences show how complex the global luxury market is. Need to adapt. And strong early interest in the EV is definitely encouraging for their big electric push.
Pricing actions in the U.S. to counter tariffs might actually help residual values, they think. They have put prices up on cars, and personalization pricing was adjusted before. Non-car revenues, mostly sponsorships, should stay pretty steady for the rest of the year. Tax rate projected around 22% for 2025, thanks to something called the patent box regime. CapEx guidance held steady at 950 million euros.
That patent box regime, it basically offers lower tax rates on profits from patented innovations. Good for R&D heavy companies like Ferrari. Stability in non-car revenue and clear guidance on tax and CapEx helps paint the financial picture.
Just clarifying that 40-40-20 target from 2022, that's about the mix of models offered by 2030, EV, hybrid, ICE. Not necessarily the sales split, they might update on that in October. And early signs for the Purosangue. Strong residual values, some used ones selling above list. And about 10% of buyers are new to Ferrari. That's interesting.
Yeah, important distinction on the 40-40-20 target. And the Purosangue data is strong residuals. Attracting new buyers, that's exactly what you want to see for a model expanding their range. Very positive signs.
The dip in Greater China deliveries. Attributed to tax impacts on current models, especially V12s. Future models are planned to fit better there. Target for the region remains 8-10%. Hybrid warranty adoption is growing, around 550 contracts now. Better communication helping there. And finally, while they didn't give exact numbers on the US price hikes, they confirmed increases up to 10% on some models, so they are actively adjusting.
Right, the China situation highlights the need to tailor the portfolio, and growth in the hybrid warranty suggests growing comfort with their electrified tech.
So, wrapping up the investor context here, Ferrari's Q1 really shows a company firing on, well, pretty much all cylinders. Strong financials driven by that focus on high-value cars and immense brand loyalty. Clear strategic progress on electrification, continued success on the track and the road. It builds a compelling story.
Definitely. And while there are potential headwinds out there, economy, tariffs, currencies, they seem to be managing them proactively. That strength in personalization really underscores their pricing power and how engaged their customers are.
All right, time for our This Is Not Financial Advice segment, our, let's call it, wild but plausible trade idea for the week. Given Ferrari's focus on high revenue per car and the hype they're building for their EV with that staggered reveal, think about this. Instead of Ferrari stock itself, maybe look at a specialized supplier of, say, high-performance, lightweight composite materials, the kind needed for luxury EVs. Ferrari's likely using cutting-edge stuff, maybe partnering closely with a niche player. A long position there could be an indirect play on Ferrari's premium EV success, possibly avoiding some broader auto market risks. Just a thought experiment, remember?
That's an interesting angle. Focusing on the enabling tech, the key suppliers in that high-end EV space.
Yeah, could offer a different kind of exposure. Definitely something to think about.
So in conclusion, Ferrari's Q1 2025 earnings call painted a picture of robust health and clear strategic direction. They seem confident. As always, we encourage you to dig into the investor relations materials yourself and see how this fits your own thesis. What part of Ferrari's strategy or performance stands out most to you? Let us know your thoughts.